Why should you care about how to invest, how it works? Many just want to turn the key and fire up the engine of wealth. After all, there are thousands out there for hire who say they already know how to invest.
Volatility in the market, wolf style.
Getting closer to your investment goals starts with a conversation.
What's in your safe?
Call now to get a free gold kit.
Where to get in, where to get out. If only the signs were as obvious when you trade.
But how do these commercials help an investor understand how to create personal or family wealth? The mass marketing complex of the media and Wall Street is built on confusion.
Your investment goals, free gold kit.
The Active Trader Pro.
And the result is the investing fog.
The fog is all around you. Pick up a magazine about investing, fog. A book about investing, the fog. The internet, fog. Go out to dinner with your family, trying to have a nice time. You look above the TV, above the bar, and there's a big, huge arrow pointing up or down and some talking head. You're in the fog. The fog is pervasive and everywhere.
Being good at life is about planting the right seeds.
Tennis racket for a squirrel. He's got a killer backhand.
It's invasive. You don't even know you're in it. You were born in it. It's in the background of your entire life. It's in your very being, because the fog is outside and inside. And if you let it, it could choke you and your portfolio to death.
Knowing how to invest, how it really works, is about the rewards of having endured the daily struggle of years of life's obstacles. Life's accomplishments, intergenerational family stability, mobility, endowment, enjoyment of then and now and the future, securing your American dream. It's all connected to knowing how to navigate the fog and complexities of successful investing. But how does an individual know if the fragile, ever-altering aspects that might connect with investment affect their portfolio? What if Social Security bankrupts? Do my investments take a hit? The cost of a barrel of oil, taxes, transforming political landscapes, the economy, who measures the economy, and how does it affect investment? Mortgage rates, the strength of the dollar, crime costs, government legislation, gross national product. What about international trade, port security, homeland security, cyber terrorism, or cyber war? There's a classic military expression, the fog of war. Military commanders explain it as war is so wickedly complex, it's beyond the human mind to comprehend all of the variables. Military experts use the term fog to describe war's ambiguities. 3/4 of the factors on which action is based are wrapped in a fog of uncertainty. The financial equivalent in the 21st century is the fog of investing. How do you navigate the incomprehensible variables, predicaments, and the realm of uncertainty surrounding investment decisions? Doesn't an investor owe it to themselves to protect the future they have earned? Why should you care about knowing how it works? To escape this dense shroud of utter confusion, navigating the fog of investing.
The financial professionals themselves are in a fog. I've taught literally thousands of financial professionals over the last 25 years, and seldom, if ever, do they truly understand the difference between investing people's money to help them meet their life's dreams versus speculating and gambling with it. And that can lead to devastating results.
Author Mark Matson, founder of a financial coaching firm managing billions of dollars for thousands of clients throughout the United States for over a quarter of a century, says beware of 3 types of Wall Street bullies that cost investors terrible tolls.
Con man is the easiest one to spot after the fact because they're the people that end up in orange jumpsuits. People can think about Bernie Madoff.
They seem to be charismatic, they seem to be connected, they seem to be credible, but they can lead to devastating disaster to your future dreams. The second are the prognosticators, and these are the people that tell you they have some kind of a crystal ball that tells them where to be in the future, some kind of forecast. Should I be in stocks? Should I be in bonds? Should I be in international? Should I be in commodities? And their scheme always revolves around pretending they can tell you where exactly to put your money in the future to get huge returns. And then of course there's the guru, and the guru is the person who tells you, look, their inside connections, their understanding of the market, their fundamental analysis will help them to determine what stocks are going to beat the market, what stocks are going to underperform the market, and then hypothetically how you can get in all the winners and get rid of all the losers. They call this active management. I call it a scam.
These three types of bullies depend on three flagrant myths after they capture funds: market timing, stock picking, past performance or track record investing.
Wall Street Bullies use all three types of speculating and gambling to keep investors in a perpetual, thick, dense, confusing fog.
First, let's examine the perils of market timing. A market timer, also known as a prognosticator, says get in because the market's going to go up, or get out because the market is going to go down. Well, how does anyone know what the markets of the world are going to do? In 2004, this program interviewed Mr. Harry Dent. He had just released the book, The Next Great Bubble Boom. On page 6, he predicted the Dow Jones could reach as high as 35,000 to 40,000 by late 2008 or in 2009. We asked how he could see the future so clearly.
Well, you know, the difference is we do use a science called demographics. We know when the average family earns the most money, spends the most money, is the most productive, when they borrow, when they save, even when they eat potato chips or buy motorcycles in midlife crises.
I told Mr. Dent we had been interviewing leading academics, including the brilliant 1990 Nobel laureate in economics, and he would never agree with Mr. Dent. Dr. Harry Markowitz received the Nobel for his groundbreaking research on modern portfolio theory. Dr. Markowitz says prediction is a guess, not a science.
If anybody tells you they know with any kind of precision which way the market will move, run, do not walk in the other direction.
But Mr. Dent seemed to consider academic data out of date, Nobel laureates out of touch.
I hate to say it, but that's kind of like having a discussion hundreds and hundreds of years ago trying to tell somebody the world's round when everybody thinks it's flat.
Dr. Markowitz was born in 1927, well after the debate was settled about the world being round. And his list of accomplishments and intellectual achievements on behalf of investors are only enhanced by time. His academic response is cycles, technology, and innovation are factored by world markets, but not with precise, predictable results.
We don't get rid of uncertainty. We don't predict the market. We just ask what combinations of asset classes of securities will give you a portfolio which has least volatility for a given expected return, but that won't eliminate its volatility.
The only objective way to interview a prognosticator is to record the predictions, let the time period lapse, then measure, clairvoyant or an inaccurate human hunch. Remember, the new book he was promoting in October 2004 had this prediction on page 6, which he repeated during our solo interview.
We've got one scenario that says the Dow hits 32,000. I think the most likely is 35 to 40,000, closer to 40,000.
In fact, the Dow Jones did not reach 40,000 by 2009, which would have been a 225% return. Using historical price data from Yahoo Finance, the Dow Jones peaked during the prediction period at 14,198 in October 2007. But it closed at 10,428 December 31, 2009. The prediction period return was not 225%, but a negative 2.8%. Dan Solon, author and securities fraud attorney.
All of the academic studies that show conclusively to any fair-minded, objective person that nobody has the ability to tell you where the market is headed.
But Mr. Dent had more prognostication from our 2004 interview. Apparently, the book he would release in 2009 was already on his mind.
We're projecting a strong bust from 2010 to 2022.
At the release of this documentary, factual market statistics were available from January 2010 through the end of January 2017. It had not been a bust period. In fact, for the first time in its long history, the Dow Jones surpassed 20,000 in January 2017.
It's morally reprehensible when these so-called prognosticators, gurus, and conmen use fear and greed against investors to whip them into a perpetual state of either fear, anxiety, and pain, or exuberance, greed, and euphoria. In either case, whipsawing them between imprudent actions of speculating and gambling when prices are high, and panic and fear and getting out of the market when prices are low. And to make the matter worse, these are much needed funds that most Americans need to fulfill in their retirement and their American dream. This is real people and real destruction.
In our solo interview, Mr. Dent had recorded erroneous predictions of wild, thrilling upturns and stormy, chilling, bust period downturns. In a separate print interview, he predicted the Dow would graveyard spiral to 6,000 in 2016. Yahoo Finance shows the close, December 30, 2016, off again, this time by 13,762 points. Securities fraud attorneys say this ongoing ruse of prognostication is among the oldest tricks in the profession and unlimited in products to pitch.
There is no ceiling to the price of gold.
His Wikipedia page describes Mr. Peter Schiff as an investment broker, author, and radio personality. The financial media describes him as
Peter Schiff, a known gold bug.
Investopedia defines gold bug as an individual bullish on gold, and Mr. Schiff has become its leading prognosticating pitchman.
And eventually, then the price of gold is going to skyrocket.
If you had followed even some of Peter Schiff's advice, you could have ended up with disastrous portfolio results.
Remember the gold bug's prognostication from October 2011.
There is no ceiling to the price of gold.
If a viewer had speculated on this gold rush, a $100,000 bet would have declined to $70,700 by the end of 2016, while the same investment in the less flashy S&P 500 index would have increased to $203,700, a difference of $133,000.
The challenge for investors is to dump this seductive idea that they need some kind of forecast or prediction about the future to be successful. In fact, if your portfolio needs a forecast or a prediction about the future to work, it's already broken.
I think there are three kinds of people who make predictions in the market.
Burton Malkiel is professor of economics, Princeton University, and the author of the perennial bestseller, A Random Walk Down Wall Street.
Those who don't know, those who don't know they don't know, and those who know darn well they don't know, but get big bucks for pretending to know.
In the early 21st century, the new stock-picking guru, best known or most notorious, is Jim Cramer.
Other people want to make friends. I just want to make money.
He is to the financial community what pro wrestling is to the sports world. Loud and brash entertainment.
They're all gonna pay the Road Warriors way.
The fun guys in Lower Manhattan will never have a clue about.
But not very enlightening or educational. In its October 2006 issue, Kiplinger's magazine featured Mad Money, reporting a prominent previous qualification on the resume of the show's self-professed creator. She used to oversee the Jerry Springer Show.
And he's cheating on me with my foster sister.
Again, not considered a programming paragon of advanced study or erudition. Our job is to seduce, said Susan Krakauer, formerly of Springer and Mad Money, now employed as a media executive for a private investment firm. An amalgamation of Jerry Springer and pro wrestling spawned Mad Money.
Shady issue.
Personal foul!
Booyah!
Booyah, Karen!
And on this broadcast hybrid, Jim Cramer plays the guru, takes calls, picks stocks, yells out all kinds of advice.
So you make that change, and you make that change now.
This is destructive speculation and gambling with people's lives.
March 2009, Cramer was challenged by a network colleague he appeared to underestimate.
A comedian's attacking me. Wow.
The Daily
He
Show.
runs a variety show.
Variety show? What? You make it sound like I'm some kind of buffoon. just flapping my arms with crazy buttons and wacky sound effects. Exactly.
The NBC Universal Family Feud developed because Jon Stewart had the temerity to question the guru Cramer, specifically on his advocacy for Bear Stearns, videotaped just prior to its fire sale to J.P. Morgan in March 2008.
Although Jim Cramer did write an article for MainStreet.com complaining that we had unfairly used a video clip out of context to make it look like he recommended buying Bear Stearns stock a week before it collapsed. Well, we went back to the tape to listen.
Should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine.
Oh. Okay, I was wrong. Actually, it's true. He wasn't saying to buy Bear Stearns. He was simply saying that if Bear was your broker or that your money was at Bear, your money would not disappear. He was not addressing the value of holding Bear stock. So, Jim Cramer, I apologize. That was out of context. Technically, you were correct. You weren't suggesting to buy Bear Stearns. That was something that you did 5 days earlier in your buy or sell segment.
I believe in the Bear franchise. You know what? At 69 bucks, I'm not giving up on the thing.
Yeah! Of course, while Cramer wasn't giving up on Bear at 69, 11 days later, the stock market was more comfortable with it at 2.
Cramer's next pick was also questionable. He accepted an invitation to appear on Stewart's show. Stewart sliced into the myths of Cramer and Mad Money.
What it feels like to us, and I'm speaking purely as a layman, it feels like we are capitalizing your adventure.
Okay.
While Stewart broke Cramer down, later his show featured this segment.
Sir, why does Wall Street react so strongly to all the rumors from Europe and the pre-events from Europe?
It's okay, it's okay. This guy can explain all of that.
The market is random and unpredictable. Anyone that tells you they can predict where the market's going in the next 10 days or 20 days, or even a month, they're lying.
Still, it seems there is no shortage of entertainers aspiring to advise on investment.
They all are obsessed with asymmetrical risk reward. They're not big. People think they're giant. They're taking giant risks for giant rewards. The best on earth, most of them, are taking the least risk possible to get the greatest reward.
Tony Robbins, self-help guru turned money master. And in his book, he talks about something he calls asymmetric risk, where you can risk just a little bit of money, but make a ton of money. This is nothing but rank speculation and gambling, and it's destructive for an investor to have in their mind. Tony might be great with getting people to walk on fire, but not so great with helping people manage their money for their life's dreams.
In the 21st century, your money concerns, your American dream, has become investainment.
Investainment is the wrong way to invest. Investing on news, investing on tips, investing on what you see in television is just plain silly.
With expanded financial coverage in the TV, with the internet, which let people check instantly on their monitors what the prices of all the stocks were, they could buy and sell in a split second. I mean, this added to the excitement. It's almost like an online casino.
I think there's a real risk when we make, as though it were a sports event, the savings of individuals, their life savings and their retirement security, an entertaining activity. I think we're misleading folks, and it would be better if we didn't do it that way.
This is not a game. This is not entertainment, because people's lives are at stake.
If you keep in mind that the only time that fund makes the headlines is after it has performed, then it becomes very clear that's not the right time to buy it.
What you now get on television is very glib, well-dressed people who have very clever ways of presenting information.
They got a dead cat bounce, baby, and I would be out of that thing.
But what's missing is there's absolutely no support for what they're saying.
Long and strong, baby.
They're all entertainers.
They make more money, upside surprise.
There are lots of interesting things to do in life, and one of them is not throwing your money away on what you read about in the paper or see on television.
Although there is a movement, not yet widespread,
We have Mark Matson, Matson Money.
a few battling back to use television for investor education, edutainment.
My job is not to sell people what they want. My job is to advise them and coach them on what they should have long term. Building a diversified global portfolio is the game, not selling people what's sexy or what's popular.
The third myth of the Wall Street Bullies is based on past performance or track record investing. A firm advertises how successful one of its funds has been in the very recent past.
There is absolutely no evidence that performance persists over the long term.
Here's an example of track record enticement. This full-page ad ran in the November 2000 issue of Money magazine. Tech stock still hot, and it displays a #1 ranking and 5 stars. Why? Because in 1998, the fund returned 196%, and in 1999, it returned 216%. Interested? Of course. So in 2000, this is the product to advertise. However, if you responded to this advertisement, added it to your portfolio, it did a negative 51% in 2000. Fogg researchers could not find any full-page ads for it in 2001. Maybe we missed it. Or maybe the new numbers didn't make it an attractive advertisement.
For individual investors, you've got to keep the long-term focus.
Jeremy J. Siegel is professor of finance at the Wharton School, University of Pennsylvania. He is a market historian and best-selling author of Stocks for the Long Run.
Try not to follow the herd. That's so important when you're making decisions.
When pitching past performance as acceptable advice to the investing public, every commercial or prospectus is required to disclose past performance does not guarantee future results.
In my opinion, the real disclaimer should say, there is absolutely zero correlation, none whatsoever, in a manager's ability to beat the market in one period and repeat that feat in the future.
Academic investing principle #1. Protect yourself from the Wall Street bullies by disregarding their primary schemes.
The idea of a random walk is that the stock market doesn't have a memory. Where it went last day, last hour, last week, last month, doesn't tell you anything about where it's going to go in the future.
Academic investing principle #2. Work with a fiduciary who's a financial coach, not a salesperson.
A fiduciary has a bound legal and moral obligation to put the investor's needs ahead of their own. And I personally believe that that should be the standard for all investment advice.
A fiduciary does not work on commission, rather is an educator.
Commission-based brokers have a conflict of interest. They are paid only when there are purchases or sales. And very often the best judgment that can be made by an individual is to sit tight and neither buy nor sell. But a broker who's paid a commission lives by that commission, motivated by that commission.
So are stockbrokers fiduciaries? Dan Solon has been a securities fraud attorney for over 40 years.
Well, you need to send all your monthly statements to me.
He is the author of Does Your Broker Owe You Money? And he says brokers are not fiduciaries, coaches, educators, or financial experts.
Brokers are simply salesmen, and investment products is what they sell.
We have a section in our book called Brokers Are Salespeople.
Douglas J. Schultz is co-author of Brokerage Fraud and a securities fraud attorney.
The brokerage industry doesn't really want the broker to be a whole lot more than a salesman and an asset gatherer.
In an attempt to experience a stockbroker visit firsthand, Renee is undercover with a hidden camera, visiting 4 nationally known brokerage firms. She is posing as a novice investor who will inherit $1 million. What will the broker approach be? An educational seminar on how to invest, or a sales pitch to win the commission on the $1 million?
$1 million is not what it used to be. It's a nice number.
I don't like hearing this.
You know, relative to the market, we're going to be better.
The chance of anyone finding an inefficiency in the marketplace, given the global dissemination instantly of all kinds of information, is essentially zero.
It's all about the relationships. That's it. That's what's important.
I think you're right.
And, you know, obviously, yes, you can have a great relationship with your advisor, but if they're losing you money, then you know what? Something's got to go.
We're about people and relationships and managing the whole process.
You want to go with a big company and a good company, a company that's been around a long time. And there's a lot of them out there. If for any reason you have to relocate, you move to a different location, you want to make sure that, you know, you don't pick a local company that if you move away,
makes sense, yeah.
Then you know what? Okay, now I'm
You're
back to
square one.
Square
yeah.
one.
People that are making the decisions on what stocks to buy, all they do all day long,
right.
They're the smartest minds in the country.
They outperform the indexes and everything, so it's worthwhile to pay for the managers here because they bring something.
In the investing industry, one of the biggest lies is that there's someone that can pick out all the best stocks in advance. And if you just trust them with their money, they'll be able to repeat this feat into the future, making the investor rich beyond their wildest dreams. It's a fantasy, and it's one that investors should get out of their minds for once and for all.
You're the owner of the team. I manage the games.
We kind of view ourselves as like a quarterback. So we want you to come to us.
You're the team owner for the baseball team. I'm the general manager. Here's the baseball players that are going to go bat.
Gotcha.
We have more products and services at your disposal than anybody.
I will tell you this right now, we are cheaper than every other firm out there. So again, we beat all the other firms out there that you're talking to.
Very interesting.
Well, when you take a look here, the fees and commissions, the lowest. Stock returns, the highest, we get you the highest returns. Conduct, we're the second highest firm out there. Keep in mind too, whenever you hire a company, that company works for you, not the other way around.
The scariest thing about investing is there's two things, there's fear and greed.
Somebody runs way up, takes some of the money out of there and put it in the ones that are dogs, because the darlings become the dogs and the dogs then become the darlings.
Academic investing principle number 3, analyze your portfolio. It will protect against a myriad of errors, including being sold by a broker to gamble on an interesting story about a hot, cutting-edge company. For example, Global Crossing was founded in 1997. The company story? Due to the overwhelming demand for the internet, we expect explosive growth in traffic worldwide as we lay hundreds of thousands of miles of undersea fiber optic cable to connect countries and cities all over the world. This would enable the internet, or .coms, which were turning nobodies into billionaires overnight. Goldmine, so went the story. Global Crossing left its mark as one of the worst 20 bankruptcies in U.S. history. January 2002. Investor Fred Vigorito had heard a similar story about a can't-miss stock called MCI in the early 1970s, and he was impressed by a nationally known brokerage house.
And here my broker introduces me to a guy who's a vice president.
When you walk into a brokerage firm, if the person that is assigned to you doesn't have at least a title of a vice presidency, he's probably merely there just cleaning out the trash that day. They assign somebody to your account and he's dressed very nicely and maybe he's got a nice college degree, and they give him a title of Senior Portfolio International Management. You think this guy is a guru.
I thought this guy was a genius.
The portfolio pinnacle?
$2.3 million.
But Mr. Vigorito was concerned as early as the mid-1990s about the diversification, or lack of, in his portfolio.
I went to him and I said, I'm going to be retiring, I believe, in 1996. What should we do? And, you know, it was a lengthy meeting, but the gist of it was, what are we going to do with the WorldCom? And he said, don't worry about it, let's leave it as is.
WorldCom bought out MCI in 1998 and soon operated the world's largest internet network. WorldCom was a hot tech stock at a hot tech time and a darling of Wall Street until it plunged into free fall.
And I watched the stock slide from its high of, I think, $96 a share off the board.
Securities fraud attorneys Tracy Stoneman and Douglas Schultz, co-authors of the book Brokerage Fraud, represented Mr. Vigorito at arbitration. His case seemed to be a sad slam dunk. A $2.3 million portfolio slashed to $700,000 under the aegis of a nationally known brokerage house.
A virtual 100% concentration in one single stock. And so that in and of itself made it probably more egregious than most.
Mr. Vigorito won a settlement. That is, if you call a win, being awarded a fraction of the claim.
And I called Tracy, and Tracy was in tears. She couldn't believe what they had done, offering to pay $32,893, which is exactly what my out-of-pocket expenses were.
So Fred Vigorito, who had retired, went back to work.
I'm a musician, and I'm playing every job that I could possibly get.
It's a sad truth about investing that even one mistake, depending on its severity, could literally wipe out a lifetime of saving and investing.
The WorldCom bankruptcy of 2002 is still considered one of the worst corporate crimes in history. An update on Fred Vigorito. Since his interview in 2006, he continues his fight, informing innocent investors, hoping to protect them from duplicating his experience. He seeks social justice on the internet at www.change.org. Search Vigorito.
Protecting against your own misunderstanding and ignorance is the least costly, most useful thing you can do to make sure that you don't get really hurt in your investing. So diversify would be rule number one.
The answer is to eliminate all short-term speculating and gambling with your portfolio.
Gambling has nothing to do with investing. The best example you can think of, it's the analogy of a casino. And you go into the casino, and all these bettors basically would break even if it wasn't for the house, if it wasn't for the croupier.
A croupier is a person who deals the cards, reels in the dice, spins the roulette wheel. The croupier represents the house, collecting the chips and the money. If a portfolio is actively traded, the House of Active Traders, the broker version of the croupier, collects steep transaction fees no matter if the trade wins or loses. Mr. Lewis Harvey is founder and president of the Boston-based company Dalbar. Its mission is to objectively examine the behaviors of investors and the retail financial industry.
Investors tend to do just the wrong thing at the wrong time.
In an ongoing study that is updated every year by Dalbar Research, it's called Quantitative Analysis of Investor Behavior, the average equity mutual fund investor has consistently underperformed the S&P 500 over 30-year time periods. The results are startling. Typically, the average equity mutual fund investor has experienced returns around 3 to 4%. While the S&P 500 index over the same time period has returned 10 to 11%. The cost of fees and expenses, trading and turnover, destructive investor behavior lost 60 to 65% of the potential gain. Dr. Eugene F. Fama, Nobel Laureate Economics 2013, talks about the negative impact of fees and expenses on the portfolio and says, academic data suggests it's very difficult to find managers who possess the skill to beat the market.
If I really am a manager who can tell good from bad, that's a human capital skill. And the economics of human capital says the returns go to human capital, not to the investors. So what you would expect is those managers extract through fees and expenses all the gains that they can possibly generate. Now, the problem is they seem to extract more than that. It's because even the bad ones extract fees and expenses.
In real dollars of a given 30-year time period, a hypothetical $10,000 investment made by the average equity investor would have left on the table over $100,000 of a possible $200,000 gain. much of it going to the brokerage house via its croupier brokers.
And that's what we have in Wall Street. The croupiers of the financial system. So all investors get the market return until the croupiers get their big rakes there on the table and scrape off their share. And then all investors lose to the market, like all investors, like all gamblers do, lose to the house.
Academic investing principle number 4. Ask the right questions. For instance, why is the goal market return?
There is no way of beating the total market because the total market is the market.
Dr. Charles Ellis has taught finance at both Harvard and Yale. He's the founder of Greenwich Associates and the best-selling author of Winning the Loser's Game.
For you to win, I have to lose. And none of the bright, smart, well-educated, hard-working managers wants to lose. Certainly not for their clients. So they're all doing their very best. So they tend to cancel out minus the cost of playing the game.
Academics believe that most investors are unaware of what this historic return chart documents. The market has delivered generous returns to those who are clear from the fog, those who do not gamble or speculate with their portfolio. Mark Matson explained market returns and free market capitalism on this network television appearance.
Mr. Matson, how do you feel about capitalism? A lot of people think it's immoral. Is it?
No, capitalism is the most moral form of government and economic formats of distribution of income because capitalism is based on the consumer. The consumer determines who has wealth in capitalism by voting, by spending dollars on products and goods. In socialism, socialism is based on a government official determining who has resources and taking it from the rightful owner and distributing to others who didn't earn it. And that is the basis of not only socialism, but communism. A capitalist asks, how can I benefit and create values for others? A socialist asks the question, how can I confiscate money that's been created by others and distribute it to myself and my power base underneath me? And it's the most destructive form of government and economic structure imagined by mankind. Karl Marx did more damage to this world than any other individual that's ever existed.
Clarity from the investing fog for the Main Street investor is attained by eliminating the panic and confusion promoted by Wall Street and bully-proofing your portfolio through academic investing principles.
The largest risk factor in all of their investing is not in the stock market, it's not in the economy, and it's not in the companies. It's inside the individual person, himself or herself. As people, we do more harm to our investments by a long shot than any other force does harm to our investments. We get confident when stocks are up. We feel great when the stocks we own are way up. We get uncomfortable and scared when stocks go down. It's a shame, but that's the way we're organized. And I'm sure it did us a lot of good back in the days of the caveman when we needed to get scared quickly or to get out of trouble. But it doesn't work in investing. And the ability to stay the course and not get shaken loose is a terrific talent.
No one could tell the future to be certain. No one can tell where stocks are going to be at any point in time. But what I found was remarkable is that over 200 years of unbelievable changes that our economy has undergone. We went from a 90% agricultural economy to an industrial, now a post-industrial economy. We have gone through tremendous sociological changes as well as economic changes. And yet the returns long run on the market have been between 6 and 7% per year after inflation. I feel comfortable looking ahead and saying if you're going to hold for the long run, 20 years, 30 years, people put it in their retirement, I feel comfortable with saying that's the return that you're going to get. I can't predict every incident along the way, all the good and bad things that are going to happen to the world. But I think those basic factors that drive returns, drive productivity in our market economy, in our capitalist economy, those basic factors I think are going to persist in the future.
So to navigate the fog of investing is ultimately an internal journey, looking at your own humanity, your instincts, your emotions, and your perceptions, and then marrying those with the so much needed academic research to build a portfolio that doesn't need a forecast or a prediction about the future. And then having the lifelong discipline to stay focused to achieve all of your most important dreams.